Welcome back to Boni's Life, where we cut through the noise to bring you the unvarnished truth about the global economy and your money. Today, we are diving deep into the most significant financial shift of 2026, one that will impact every single portfolio, every crypto wallet, and every mortgage payment for the next 4 years: the swearing in of Kevin Maxwell Warsh as the 17th chairman of the Federal Reserve. Now, if you think this is just another suit taking a seat in Washington, you need to think again, because this man carries a paradox that Wall Street is still trying to figure out. Warsh was born on April 13th, 1970, in Albany, New York, the youngest of 3 children in a Jewish family. His father, Robert, was a school uniform manufacturer, and young Kevin grew up playing varsity tennis at Shaker High School, even appearing in local television commercials and the 1987 film Ironweed. His love for tennis took him to Stanford University, where he studied public policy and helped Hoover Institution economists build computer models. He graduated in 1992, considered staying for a doctorate in economics, but at his father's insistence went to Harvard Law School instead, graduating cum laude in 1995. He also completed advanced coursework in market economics and debt capital markets at MIT. After law school, Warsh joined Morgan Stanley in 1996 as an associate in the Mergers and Acquisitions division, eventually rising to vice president and executive director of investment banking. He was working at Morgan Stanley's headquarters on the morning of September 11, 2001, and witnessed the collapse of the World Trade Center from his office window. That experience fundamentally changed him, motivating him to leave Wall Street and pursue government service. In April 2002, President George W. Bush named him Special Assistant to the President for Economic Policy and Executive Secretary of the National Economic Council, where he managed domestic finance, capital markets, and banking issues, and played a key role in crafting the Sarbanes-Oxley Act in response to the Enron and WorldCom accounting scandals. Then, in January 2006, at just 35 years old, Bush nominated Warsh to the Federal Reserve Board of Governors, making him the youngest person ever to serve in that role. During his tenure from 2006 to 2011, Warsh became one of the 4 musketeers, as described in David Wessel's book In Fed We Trust, alongside Ben Bernanke, Vice Chairman Donald Cohn, and Timothy Geithner. He was the Fed's central liaison to financial markets during the worst financial crisis since the Great Depression, directly involved in the emergency sale of Bear Stearns to JP Morgan Chase, the bankruptcy of Lehman Brothers, the bailout of AIG, and the conversion of Morgan Stanley and Goldman Sachs into bank holding companies. But here is where it gets interesting. Despite being Bernanke's right-hand man during the crisis, Warsh eventually broke ranks. He vehemently opposed QE2, the Fed's plan to purchase $600 billion in Treasury securities, warning it would ignite runaway inflation. When he lost that argument, he resigned in March 2011. After leaving the Fed, he became a lecturer at Stanford Graduate School of Business, a distinguished visiting fellow at the Hoover Institution, and a partner at Duquesne Family Office, which is the investment vehicle of legendary billionaire investor Stanley Druckenmiller. He married Jane Lauder in 2002, a granddaughter of beauty mogul Estee Lauder, whose personal fortune exceeds $2 billion, according to Forbes. Combined with his own disclosed assets, Warsh is now the wealthiest person ever to lead the Federal Reserve. Fast forward to January 30th, 2026, when President Donald Trump nominated Warsh to replace Jerome Powell. The confirmation process was anything but smooth. Senator Tom Tillis of North Carolina blocked the nomination from advancing through the Senate Banking Committee for weeks, citing concerns about a Department of Justice investigation into Powell. Tillis only lifted his block on April 27th after receiving assurances about the investigation's scope. Warsh appeared before the Senate Banking Committee on April 21st, where he was grilled on Fed independence, and the committee advanced his nomination in a tight 13-11 vote. On May 13, 2026, the full Senate confirmed Warsh in a 54-45 vote, the narrowest confirmation for a Fed chair in United States history. Only one Democrat, Pennsylvania Senator John Fetterman, crossed party lines. Justice Clarence Thomas administered the oath of office at the White House on May 22nd, 2026, launching Warsh's 4-year term that runs until May 21st, 2030. So, what exactly does this regime change look like? And what kind of Fed chair will Kevin Warsh actually be? This is where the analysis gets fascinating, because Warsh is sending signals that seem contradictory on the surface, but reveal a coherent strategy when you dig deeper. In his swearing-in speech, Warsh outlined 3 core priorities: restoring the Fed's integrity, maintaining price stability and low inflation, and achieving full employment. He vowed to lead a reform-oriented Federal Reserve, learning from past successes and mistakes. Now, historically, Warsh has been viewed as a strict inflation hawk. Sonal Desai, chief investment officer at Franklin Templeton Fixed Income, recently stated on Bloomberg's Real Yield program that Warsh is the most hawkish nominee we've had in 20 years, but she also added that we should give him the benefit of the doubt. However, Warsh is currently singing a more nuanced tune than his 2008-era self. He is pushing the narrative that artificial intelligence is a significant disinflationary force that will boost productivity and ultimately justify lower interest rates. In a November 2025 Wall Street Journal op-ed, he argued that AI-driven productivity gains would be transformative, and that the Fed should factor this into its inflation framework. He also favors looking at trimmed mean and median inflation rather than the traditional core personal consumption expenditures index, essentially throwing out the extreme price shocks like the recent energy spikes from the conflict in Iran to get a smoother, more accurate inflation rate. Brian Levitt, chief global market strategist at Invesco, analyzed Warsh's confirmation hearing and concluded that what he heard was broadly dovish, pragmatic, and respectful of institutional independence, adding that markets generally seem to agree, and that this combination is supportive of stocks. The Cato Institute has published a reform agenda for Warsh that includes reopening the monetary policy framework review, shrinking the balance sheet, ending interest on reserves, and committing to rules-based policy. Meanwhile, Edward Jones has described Warsh's approach as hawkish easing, which involves lowering policy rates while strictly avoiding quantitative easing, meaning no direct printing of money to buy bonds. Based on his historical conduct, public statements, confirmation testimony, and the current economic environment, I am assigning 3 probable scenarios for his tenure. Scenario 1, which I give a 40% probability, is the hawkish disciplinarian. In this scenario, Warsh holds rates steady or even raises them, aggressively shrinks the Fed's $6.7 trillion balance sheet, retires the dot plot, reduces forward guidance, and maintains strict independence from the Trump administration. This would likely pressure stocks in the short term but strengthen the dollar and anchor long-term inflation expectations. The bond market would approve, but equities would struggle. Scenario 2, at 35% probability, is the pragmatic reformer. Here, Warsh uses the AI productivity narrative to justify gradual rate cuts while slowly trimming the balance sheet. He implements new inflation measurement frameworks, balances independence with the administration's goals without appearing subservient, and modernizes Fed communications. This is the Goldilocks scenario for markets, supportive of both stocks and crypto. The third scenario, at 15% probability, is the political accommodator, where Warsh bows to the administration's demands for cheap money, uses trimmed inflation measures to justify premature rate cuts, and risks long-term credibility. This would spark a massive short-term rally in risk assets, including Bitcoin and altcoins, but could trigger a bond market revolt and a dollar crisis down the line. There is also a fourth scenario at 10% probability, the crisis manager, where an external shock, whether from the Iran conflict escalation, a sovereign debt crisis, or a banking system stress event, forces Warsh into emergency action, potentially returning to the crisis-era playbook he knows so well from 2008. Timothy Lane, former deputy governor of the Bank of Canada, offered important context when he noted that the chair has a lot of influence automatically just by being chair, but that's not enough by itself. There's a need to win over other people to his way of seeing things, and that's something that could take a little bit of time. Remember, the FOMC is not a one-man band. It has 12 voting members, and at the April meeting, 4 of them dissented. the most divided the committee has been since 1992. Now, here is the wild card that mainstream media is largely glossing over, and the aspect that makes Warsh unlike any Fed chair in history: his unprecedented connection to the cryptocurrency industry. Before taking office, Warsh disclosed over $100 million in crypto-related investments. This is not some passive index fund exposure. His holdings include direct equity in Flashnet, a Bitcoin Lightning payment startup, stakes in Bitwise, the crypto index manager, positions in Polymarket, the prediction market platform, equity in DYDX, the decentralized derivatives exchange, and a position in Basis, a stablecoin project. Through venture fund structures, he holds equity positions in more than a dozen blockchain and digital asset companies spanning DeFi lending, decentralized derivatives, Layer 1 and Layer 2 networks, prediction markets, and Bitcoin payments infrastructure. He also holds equity in SpaceX and various AI companies. While ethics rules dictate he must divest these holdings, and he has pledged to do so, his foundational views and understanding of the crypto ecosystem are already deeply set. This is a man who has skin in the game, who understands the technology from an investor's perspective, not just a regulator's perspective. His public statements on Bitcoin have been consistently constructive. At a Hoover Institution event, Warsh described Bitcoin as an important asset and a very good policeman for policy, framing its price as a signal of confidence in the Fed's inflation management rather than a threat to dollar dominance. He has also described Bitcoin as the new gold for people under 40. When asked directly about Bitcoin during his confirmation process, he stated that it does not make him nervous. Furthermore, he vehemently opposes a central bank digital currency, which is a massive signal. A CBDC would have been the government's tool to compete directly with private cryptocurrencies, and Warsh is taking that option off the table. Instead, he strongly favors private sector-issued stablecoins, perfectly aligning with the Crypto Clarity Act that Congress is expected to pass in 2026. SEC Chair Paul Atkins has stated that this legislation will establish clear rules for digital asset classification and trading. Michael Saylor of MicroStrategy, now rebranded as Strategy, remains incredibly bullish, noting that this pro-Bitcoin stance at the highest level of monetary policy is a structural tailwind that will help Bitcoin outperform the S&P 500 over time. Saylor recently stated on CNBC that he expects Bitcoin to continue its trajectory as the premier store of value. For the crypto industry, Warsh represents the most friendly regulatory environment we have ever seen at the Federal Reserve. His leadership is expected to influence how willing banks are to engage with digital assets, likely paving the way for clearer bank custody standards, deeper institutional integration, and a more permissive environment for stablecoin issuance. The combination of a pro-Bitcoin Fed chair, the Crypto Clarity Act, and SEC chair Paul Atkins creates what many in the industry are calling the most crypto-friendly regulatory trifecta in American history. However, and this is the balanced view you need to hear, there is a legitimate concern about conflicts of interest. Even after divesting Warsh's network, his relationships with crypto founders and his philosophical alignment with the industry could create perception problems. Critics argue that a Fed chair who personally profited from crypto may be biased in setting monetary policy that affects digital asset prices. This is a valid concern that the market will be watching closely. Despite the optimism surrounding his crypto stance and AI narratives, the immediate reality facing Warsh is stark, and the market's assessment is deeply cautious. Let me walk you through what the CME FedWatch tool is telling us right now, because this is the most important data for any trader or investor watching this transition. As of May 24, 2026, the FedWatch tool shows a 0% probability of any interest rate cuts in 2026. Zero? Let that sink in. The market is pricing in absolutely no chance that Warsh will cut rates this year. In fact, roughly 70% of investors are pricing in at least one rate hike by December 2026. For the next FOMC meeting on June 17th, which will be Warsh's first as chair, 3.5% of investors forecast a 25 basis point rate hike. For the July meeting, that probability surges to 17%. And by December, approximately 67 to 70% of investors expect the Fed will have raised rates at least once. The current federal funds target rate sits at 3.50% to 3.75%, and the April Consumer Price Index came in at 3.8% year over year, a 3-year high that has been climbing from 3.3% in March. This is well above the Fed's 2% target, which has not been consistently achieved for over 5 years. JP Morgan strategists anticipate that the Fed will keep rates steady through the end of the year as rising energy costs from the Iran conflict fuel ongoing economic uncertainty. Their base case is for the unemployment rate to remain relatively stable while inflation stays elevated, creating a stagflationary environment that limits the Fed's options. Ed Yardeni of Yardeni Research goes further, suggesting the Fed will have to raise rates as early as July just to appease the bond vigilantes, those powerful fixed-income investors who sell government bonds when they believe inflation is not being adequately addressed. However, there is a strong contrarian view that deserves serious attention. Analyst and investor Lawrence Lepard argues that Warsh will absolutely cut rates, defying the consensus. Lepard's thesis is that Warsh will use the AI productivity boom and his preferred trimmed inflation metrics as justification, writing off current inflation as temporary war-driven anomalies. Lepard wrote, non-consensus view, Warsh will cut. He will use the AI productivity and trimmed inflation excuses. Will claim all the war inflation is transitory. 2 data points from today's Wall Street Journal support this view. This creates a massive tension in the markets. The hard data screams hold or hike, but the new chairman's underlying philosophy, his AI productivity narrative, and the administration's relentless pressure all scream cut. The New York Times editorial board recently published a piece titled "Kevin Warsh is already getting it wrong," arguing that his AI-driven disinflation thesis is premature and that productivity gains from artificial intelligence have not yet materialized in the economic data. The Cato Institute, while supportive of his reform agenda, has also warned that his inflation solution could be a trap if AI productivity fails to deliver as promised. This intellectual tension between Warsh's forward-looking AI thesis and the backward-looking inflation data will define the first 6 months of his tenure and create significant volatility in both traditional and crypto markets. For traders and investors navigating this historic transition, the next few weeks and the lead-up to Warsh's first FOMC meeting on June 16th and 17th are absolutely critical. The technical triggers to watch are the 10-year Treasury yield and the dollar index, known as the DXY. If the 10-year yield breaks above 4.5%, it signals the bond market is forcing Warsh's hand toward the hawkish scenario, which will trigger a short-term sell-off in risk assets, including Bitcoin, equities, and high-yield bonds. Conversely, if we see the DXY weaken below 104, it indicates the market is buying into the AI productivity rate cut narrative, which would be bullish for risk assets across the board. For your optimal trading strategy over the next 24 to 48 hours and into the June FOMC meeting, consider a barbell approach. On one side, maintain exposure to hard assets like Bitcoin and gold, which serve as a hedge against both inflation and the potential for politically motivated rate cuts that could debase the dollar. On the other side, keep dry powder in short-term treasury bills yielding around 5%, giving you the flexibility to buy the dip if the Fed is forced to hike. JP Morgan's wealth management team recommends considering real assets including commodities, natural resource equities, infrastructure, and global real estate, which have historically shown positive correlation to inflation while offering lower volatility than broad equity markets. They also highlight emerging markets, where corporate earnings are expected to grow 46% in calendar year 2026, and gold as a hedge against inflation volatility and currency dispersion. The key signals to watch from Warsh's first meeting will be how the FOMC's policy statement language evolves, whether committee dissent rises or falls, and how Warsh communicates after the meeting. Remember, he has hinted at potentially retiring the dot plot and reducing post-meeting press conferences, which would itself be a market-moving event as it removes forward guidance that traders have relied on for years. Warsh is promising a regime change, but remember, the Fed is a massive ship that turns slowly. As Timothy Lane noted, winning over the other voting members takes time. The real question is not what Warsh wants to do, but what the data will allow him to do. If inflation continues rising toward 4%, even the most dovish intentions will be constrained by market reality. If AI productivity gains start showing up in the data, Warsh will have the intellectual cover to cut. Stay vigilant, watch the data, and do not let the mainstream narrative blind you to the underlying mechanics of Wall Street and the crypto markets. The Warsh era has begun, and whether you are holding Bitcoin, stocks, bonds, or cash, the decisions made in that building on Constitution Avenue will determine your returns for years to come. Thank you for joining me on Boni's Life. Stay sharp, stay informed, and I will see you in the next episode.